In its first 2 months as a public company, SpaceX was worth $3 trillion, then lost more than half of that, then fell below its own offering price, then survived the single largest release of insider shares in its history without breaking, and then rallied more than 30%. Same company, same rockets, same satellites. Nothing about the business changed that fast. What you are watching is a market trying to price something it has no template for, and that process is far more instructive than any price target. Before we begin, the disclaimer: I am not a financial advisor, and this video is for education and entertainment only. Nothing here is investment, tax, or legal advice, or a recommendation to buy or sell any security. Everything about the next 10 years is a scenario, not a prediction. Investing involves risk, including the loss of your capital, and newly public companies can be especially volatile. Past performance does not guarantee future results. I may hold some of the assets discussed. Always do your own research and consult a licensed professional before making any decision. And welcome to the channel. Here we go deep. No surface level tips, no hype. We break down the real mechanics that move markets and the money inside them. Today, the biggest market debut in history. SpaceX just went public and it became one of the most valuable and most expensive companies on Earth overnight. So let's do the work. What are its businesses? Where does the money actually come from? What is it trying to do that nobody else can? And what could the next 10 years really look like? On June 12, 2026, SpaceX listed on the Nasdaq under the ticker SPCX. It was the largest initial public offering ever recorded, and within hours it was worth more than $2 trillion, making it one of the 5 or 6 most valuable public companies in the world. Here is the tension that makes this so interesting. The company lost almost $5 billion last year. So you have one of the most remarkable businesses ever built, listed at one of the most extreme valuations the market has ever seen. Both things are true at once. Let's untangle it. First, the scale of the debut. SpaceX priced its shares at $135 and raised about $75 billion in a single offering, a record. Demand was reportedly more than 3 times the shares on offer. On its first day, the stock opened around 150, touched the mid-170s, and closed up roughly 19%. In the days that followed, it ran higher and then pulled back, the kind of whipsaw you expect when a giant, story-driven name meets a thin, early float. The headline number, a company valued north of $2 trillion on day one. Now let us bring this up to date because a great deal has happened since the debut. Within days of listing, the market pushed SpaceX to roughly $3 trillion. Then it reversed hard. By mid-July, the shares had fallen below their own offering price of $135, and in early August, they closed at an all-time low of $108.27. That is a decline of more than half from the peak in under 2 months. Then came 2 tests in the same week: the first earnings report the company had ever published as a public business, and the first expiry of the lockup that had been preventing insiders from selling. Both landed, and the stock climbed back above its offering price for the first time since mid-July. Now, the part that should make any serious investor pause. At its offering price, SpaceX was valued at roughly 94 times its annual revenue, and even higher as the stock climbed. To put that in perspective, mature technology giants trade at a small fraction of that. A company like Apple or Meta sits near 10 times sales, and the broad market average is around 3. SpaceX came public at a multiple with essentially no precedent among the world's largest companies. To grow into a normal valuation, it would eventually need somewhere around $150 to $175 billion of revenue, nearly 10 times what it earns today. The price is not buying the present, it is buying a very specific future. So what do you actually own when you buy this stock? After SpaceX merged with Elon Musk's AI company in early 2026, it became three businesses under one roof. One, the rocket launch business, the original engine of the company. Two, Starlink, the satellite internet network, which is now the financial heart. And three, an artificial intelligence arm, the newest and by far the most cash hungry. Each one has a completely different risk and reward profile, so let's take them one at a time because the entire 10-year case lives in how these three play out. Start with launch, and the single thing that built this entire empire, reusable rockets. For 60 years, rockets were thrown away after one flight, like scrapping a jumbo jet after a single trip. SpaceX solved the problem almost everyone said was impossible, landing and reflying the booster. That one breakthrough collapsed the cost of reaching orbit. Watch what happened to the price of putting a kilogram into space. From the space shuttle era to the Falcon 9 to the gold for Starship, the cost falls by orders of magnitude. This is why SpaceX now launches the vast majority of all the mass humanity puts into orbit, and why its launch business runs at margins most aerospace firms can only dream of. This is the moat. Next, Starlink, and this is the number that carries the whole valuation. Starlink brought in about $11.4 billion last year, roughly 61% of all of SpaceX's revenue. And crucially, it turned an operating profit of around 4.4 billion. It is the one division that consistently makes money. Look at the growth from a couple $100 million in 2021 to over 11 billion in 2025. The network passed 10 million subscribers. But there is a catch hiding in plain sight. As Starlink added cheaper plans to grow the base, average revenue per user fell about 18% to roughly $81 a month. More customers, but each one paying less. That tension is one of the most important things to watch over the next decade. Now, the third business and the reason the company loses money, artificial intelligence. The AI arm is burning cash at an extraordinary rate, on the order of $2.5 billion in a single quarter and more than $6 billion across last year. SpaceX built a massive data center packed with hundreds of thousands of chips, signed a roughly $1.25 billion a month deal to rent that computing power, and moved to acquire a leading AI coding company in a deal valued around $60 billion. The bet is enormous. That owning launch, connectivity, and AI together creates something greater than the sum of its parts. The risk is just as enormous. If that AI burn does not turn into real profit, it could drag on the entire company for years. Step back and ask why anyone would pay this price at all. The answer is that SpaceX is solving problems that right now essentially nobody else can. Fully reusable heavy lift rockets that could make space travel routine, a global internet beamed from orbit that reaches places no cable or tower ever will, the launch backbone for nearly every other space company and government on the planet, and the long shot that anchors the whole story, making humanity capable of living on more than one world. When you are the only one who can do something the world badly wants, you get to set the price. That pricing power is the real bull case, far more than any single quarter's numbers. Let's be precise about the money because the company is profitable and unprofitable at the same time, depending on how you measure it. Total revenue last year was about $18.7 billion, up a remarkable 33%. On one common cash flow measure, the business earned a profit of roughly $6.5 billion. But on a full accounting basis, it lost about 5 billion, and its losses have piled up to more than 40 billion over time. The gap is the AI burn, plus the cost of building and writing down that huge satellite network. So the honest summary is this: the core space business makes money, the AI ambition spends it faster, and the market is betting the first one wins. And now we have something the original story did not have: real quarterly numbers, audited and public. In the second quarter, revenue came in at $7.81 billion. That is up 92% from a year earlier, and it beat what analysts were expecting by a wide margin. Adjusted earnings before interest, Tax, depreciation, and amortization nearly tripled, up 191% to around 3.5 billion. The connectivity business, which is Starlink, contributed 4.3 billion and added 1.7 million net subscribers in a single quarter. The artificial intelligence segment grew 247% to 2.6 billion, and the company still recorded a net loss of $541 million, growing extremely fast and still not profitable on a full accounting basis. Both remain true. So, the next 10 years, let's run three scenarios, and remember, these are possibilities, not forecasts. First, the bull case. Starship works and reliable, fully reusable flight drops the cost to orbit to almost nothing. Starlink grows from 10 million subscribers toward 100 million and becomes the world's connectivity backbone. The AI arm matures into a genuine profit center instead of a cash drain. Revenue climbs from under 20 billion toward 150 billion or more, and the company finally grows into and then past its valuation. In that world, today's eye-watering price turns out to have been cheap, and SpaceX becomes one of the defining companies of the century. Now, the bear case, which is just as plausible, the AI burn keeps accelerating and never turns profitable. Competition arrives from Amazon's satellite network and from heavily subsidized Chinese rockets, and Starlink's price per user keeps falling. Starship hits costly delays, as brand new rockets often do, and that 90 plus times revenue multiple compresses violently because a single year of bad news on a stock priced for perfection can erase enormous value. On top of that, when the early investor lockup expires, likely around the end of 2026, a wave of insider selling could flood the market with shares. One independent valuation already pegs fair value more than 50% below the IPO price. In the bear case, this is a great company and a terrible stock. So, where does professional opinion sit after those results? Still nowhere near agreement, which is the honest answer. Morgan Stanley reiterated an overweight rating with a $300 target and floated a bull case as high as 600. Citi raised its forecasts for this year and next. Meanwhile, independent valuation specialists have published fair value estimates well below where the shares trade, in some cases around half the offering price. Note also that ahead of earnings, the amount of money bet against SpaceX exceeded the short interest in Tesla, which is normally one of the most heavily shorted names on the market. When the range of serious professional opinion spans a factor of several times, that is not a glitch in the data, it is the signal. Nobody knows. And here is the event I want to single out because it was genuinely the most interesting thing that happened. And because if you watched an earlier version of this story, you may still be waiting for it. The first lockup expiry has already occurred. On the 6th of August, roughly 911 million shares became sellable. To put that in proportion, that is more shares than were sold in the record-breaking initial public offering itself, somewhere around $100 billion of insider paper suddenly free to move, arriving 2 days after the first earnings report. The widely expected outcome was a flood of selling. It did not happen. Volume was enormous, but the shares were absorbed rather than dumped, and the stock rose afterwards. That tells you something a price chart alone does not. At these levels, there was real demand waiting underneath. There are further lockup tranches still to come, so this is not finished, but the first and largest test has been passed. The practical part, and one detail that matters a great deal to this audience, because SpaceX is now an ordinary listed stock, you can buy it directly through almost any broker. If you invest from Europe, note the distinction carefully. You can generally buy the individual share through an international broker, but many of the American funds that hold it are not available to European retail investors under local rules, so check what you can actually access before you plan around it. Two things left to watch. Index inclusion, because the exchange changed its rules, so a company this size can enter the main index within weeks rather than a year, which would force passive funds to buy, and the remaining lockup trenches, since the first one is now behind us. Those mechanical events, rather than the headlines, are what tend to move a stock like this. To wrap up, SpaceX is by almost any measure one of the most extraordinary companies ever built. It solved reusable rockets, it wired the planet from orbit, and it is now growing revenue at 90% a year while still losing money on a full accounting basis. It also came public at a price that already assumed a decade of near flawless execution, and the market has spent 2 months violently arguing with itself about what that is worth. A generational company is not the same thing as a generational stock at any price. Whether the next 10 years vindicate the bulls or the bears, the discipline does not change. Understand exactly what you are buying, size it so that being wrong is survivable, and remember that a story this large attracts a lot of confident people who cannot all be right. None of this is a recommendation. If this gave you a clearer view of what is actually happening with this stock, do me one small favor. Tap like, it genuinely helps more investors find this. Share it with someone who only saw the headline. And subscribe, because we do this properly every week. We do the digging, so you do not have to guess. See you in the next one.